In market news now, the JSE was firmer with its global peers mixed as minutes from the latest U.S. Federal Reserve policy meeting confirmed that U.S. rates would probably remain higher for longer. The minutes from the latest Federal Open Market Committee showed a hawkish Fed committed to the fight against inflation, but will be driven by upcoming economic data releases. Locally, the rand was flat in early trade against the U.S. dollar, losing all the ground gained in the previous session following the finance minister's budget speech. The rand has been one of the worst performing emerging market currencies this year. And company news, Distel has warned that the direct cost of load shedding on its operations might quadruple. To talk to us about the latest when it comes to the markets, we are joined by Han Tan, who is from Xfinity. Han, thank you so much for your time. I mentioned in the intro that we still are dealing with a Fed that is committed to fighting inflation. What would you say is the important thing for markets right now after those Fed minutes?
I think the important components from that Fed minutes was that, firstly, there were no surprises. And secondly, I think it's only going to carry more meaning as a base for comparison if we see any future policy shifts, right? Because keep in mind, this meeting was before we got that blockbuster jobs report and also the higher than expected inflation data. So, and also keep in mind, we've got another set of jobs and inflation data before the next meeting in March. So if the data shifts the Fed's bias between now and late March, then I think again, the previous meeting minutes would form the basis for the comparison for any changes.
One of the things they note in their meetings is the idea of the importance of financial conditions matching policy. What do you think they mean by that?
Yeah, so the idea is that with these rate hikes, you want to see borrowing costs actually go up, or to put in simpler terms, less money chasing after stuff, chasing after goods and services that are driving up inflation, right? But if you look at, say, 10-year yields, which are used as a benchmark for borrowing costs, those have actually come down since peaking around 4.3% back in October. It's fallen to less than 4% right now, even as we speak. So it is not what the Fed wants to see. Again, the Fed wants to see tighter financial conditions, borrowing costs go up, and that is hoped will subdue inflation.
I'm glad you brought up the idea of yields. Your assessment of this correlation we're starting to see with the equity markets and the bond market.
Yeah, so I think what we've seen last year is this traditional relationship whereby if stocks go up and then bonds go down and vice versa. I think that traditional relationship was clearly upended last year. Coming into this year, we did see some green shoots of maybe that relationship being restored, but the past couple of weeks have told us that there is still that disconnect. And I think that disconnect should continue as long as markets are still grappling with the uncertainty about how high U.S. interest rates will ultimately go, and also in the interim, how much damage will be incurred on the U.S. economy. So until we have that uncertainty, I think this disconnect between stocks and bonds should persist.
In the beginning of the year, say January, we saw a rally, and I'm wondering whether you think that rally is transitory or was transitory.
Yeah, I think I'll wait till the next jobs data and the inflation data before making that call. And look, to be fair to markets, we have seen ever since last summer how stocks have been willing to challenge the Fed's hawkish narrative, right? In other words, the Fed has been saying it wants to send U.S. interest rates much higher. Typically, you see stocks fall lower, but they've been willing to challenge that and just kind of take incremental steps higher, right? So I think until we get that firmer grip about where the data is informing the Fed and how the Fed intends to react, then only will I decide whether the gains that we've seen so far this year is transitory.
When you think of the outlook during the next meeting, what could get the Fed to really consider 50 basis points, given the fact that from the FOMC minutes, we're starting to see that there were more members who were leaning towards 50 basis points. We just don't know who. But what would get them there?
Yeah, two things to look out for. So firstly, we still see resilience in the US jobs market. And secondly, you still see inflation still stubbornly elevated. All right. I mean, to be clear, inflation has been on a downtrend. It's just not as fast a pace that the Fed would like to see. The last inflation data that we got was still above 6%. The Fed's goal is 2% inflation. So there's still a long way to go between now and reaching that policy target. So if inflation still remains stubborn, then I think the Fed could be hastened into going back to those more aggressive rate hikes that we saw last year.
Before I let you go, are there events or company announcements that you're paying attention to going into next week?
Yeah, well, tomorrow, in keeping with that central bank focus, I think markets or yen traders will be really paying close attention to any sort of clues that this incoming Bank of Japan governor could say to the Japanese parliament, right? Because markets had this expectation that Japan, being the laggard in central banks, among central banks, they are the only ones who have yet to hike their interest rates. So if this new governor signals even the slightest bias of wanting to join other central bankers in hiking their rates, I think then we could see a big move in the Japanese yen and spread out across into the FX markets as a whole.
Han, thank you so much for your time. That is Han Tan, who is the Chief Market Analyst at Xfinity. And adding to other events that we are watching, of course, tomorrow we've got Germany's fourth quarter GDP figures, as well as the US January core PCE deflator, which is the one key aspect that we've been trying to monitor, especially as we try to see where the Fed is going to be going when it comes to their interest rates. Interestingly to know that tomorrow is the one-year anniversary of Russia's invasion of Ukraine. However, that is it from me. We're going to take a quick break. When we come back, we'll have more news for you. Stay tuned.